This week has been quite a busy week. We start off with the RBA on Tuesday. What we saw there was not particularly large changes to the statement in terms of the narrative. They did sort of emphasise more the structural side of the commodity price decline that had been quite long-lasting and obviously very significant in terms of scale. They're also a little bit more wary about the labour market, but still remain relatively constructive on that front. What we did see, I guess, and what really sort of took the market a little bit off guard was that they did change slightly the last paragraph. So where in February they had talked about that inflation may provide scope in the future for further rate cuts, they now had inflation would provide scope for further rate cuts. The key but with that is that it's really data dependent and demand dependent. And what we saw on Wednesday was a much stronger than expected outcome for GDP, which gives them a lot more time and I guess flexibility to assess how conditions change over the next year or so before they decide they actually need to provide further stimulus to the economy. With regards to GDP, we saw there was a 0.6% gain against market expectations around about 0.4%. And that took the annual pace to 3%, which is a little bit above trend and also materially above where it was a year ago. So December 2014 growth to that point was about 2.2%. Now obviously at 3%, that's quite a significant improvement. Domestic demand overall is still quite weak, and you're seeing business investment subtract at quite a rapid rate, about 2 percentage points over the past year. But what we are seeing is a further improvement in the consumer. Through the second half of last year, we saw a noticeable uptick in terms of momentum coming through in consumption, and also dwelling investment remained quite strong, rising about 10% through the year. So that's definitely a positive side for the RBA, and it's really sort of one of the key areas which they've been hoping to see improvement in and what they believe will be what will drive the economy going forward. Now, obviously, conditions across the states are very, very different. We see Victoria and New South Wales are seeing growth at about a 4% annualised pace, and that's seeing strong growth in consumption and also residential investment and some support from the public sector as well. In contrast, you have WA contracted at more than 2% in the quarter and having seen a very, very significant decline which has been driven by business investment and the unwinding of the mining investment boom over the last couple of years. And obviously the labour market's played to that as well, with wage growth being quite robust in New South Wales and Victoria, at the same time being quite weak in WA. And that's going to be sort of one of these sort of key narratives we see going forward, is that there's a continuation of this kind of, I guess, shift of growth from the west to the east, sort of focus on being on services growth and the consumer rather than mining investment as we have had in recent years. In terms of sort of what we're seeing for the rest of the week, the other sort of key real focus was the China PMIs. They were actually noticeably quite weak and a bit of a downside surprise as well. And that obviously sort of plays into the commodity price story and sort of the belief in terms of our exports into that region. We saw in terms of the manufacturing PMIs was further negative readings, so suggesting a further contraction in activity, and new orders continue to decline as well. So we're not looking like we're right at the bottom of that sort of cycle at the moment. It looks like we'll see further contraction in production as we move forward in the next couple of months. The one positive, I guess, on that front was that inventories are being whittled down, so we are closer to a troughing of production than we have been in the past. The real kind of key risk around this at the moment is what that means for employment. We have seen in our Westpac M&I China Consumer Sentiment Survey a notable deterioration in the last 2 months and down to sort of levels that we saw in the GFC. And the employment indexes out of the PMIs really, I guess, reinforced and are quite consistent with that, which is suggesting we're seeing widespread job shedding across manufacturing in China at the moment. The other sort of major concern for us, particularly sort of with that weakness we're seeing in manufacturing and construction in China, is that the services sector PMIs have also been weakening as well over the last couple of months, and they are also seeing a contraction in employment at the moment. Now, services is really where we're expecting to see the growth going forward, and so with that, and the expectation that will provide sort of better quality jobs with better conditions and pay as well. And if we're not seeing that, then that's going to likely see sort of growth weaken from where it is now and potentially see us with a sort of 6% growth rather than 6.5%. So we'll have to see how that goes in the next couple of months as to whether we need to revise down our forecast or not. Next week, the focus is going to be very much on consumer and business sentiment. We saw an improvement in Australian consumer sentiment last time around in February, taking it back to a little bit above the sort of 100 mark, which is where optimists equal pessimists. So that's a constructive reading. But what was concerning, I guess, in the February reading was that we saw a deterioration in employment expectations. Now, that could be about sort of what we've seen in the labour market in the last few months with slowing in employment growth, but it is really important in terms of continuing that discretionary spending momentum we have seen in Q4 into Q1 and Q2 to see, I guess, a greater confidence in the labour market and a belief in wage outcomes as well. Also around housing, we continue to see a moderation in terms of people's expectations around housing, which is suggesting more modest price growth but not price declines. And at the same time, continued demand that we're seeing, I guess, for the residential supply that we are building at the moment. So they're kind of the key focus. And the other thing to note next week is going to be the ECB. There has been a lot of, I guess, hype around this meeting. Obviously, we had Draghi come out in February and really talk up the willingness to provide further accommodation if that proved necessary. Since then, we've seen inflation deteriorate, so it's now down 0.2% for the year, or in a 6-month annualised terms, it's actually down 1.4%. So that really gives them a great cause to actually act, even though growth has been okay, and we are seeing an improvement in credit creation in the economy as well. It's likely we'll see a further cut to the deposit rate and also an expansion of the QE program to really bolster confidence and try and drive momentum forward, and hopefully that will lead to inflation as we move forward. There really is a giant question mark as to whether we are going to see, I guess, this positive momentum come through after what we've seen in that economy at the moment, where there are significant structural issues which need to be addressed, and that's going to need to take, I guess, more fiscal responsibility on that front as we move forward in the next couple of years. We'll see you next week.